Now, one of the keys to the future of interest rates clearly is inflation. But just what is inflation? You think you know? It's the Consumer Price Index, right? That's the Reserve Bank's preferred measure. Between 2 and 3% is their preferred band. But do you sometimes wonder whether the CPI is not what's happening in your household or your business, that your costs, your personal inflation rate, if you like, is many times higher than the official rate? Well, the CPI has been produced by the Bureau of Statistics for more than 75 years. But the Bureau does have other measures. One of those is called the Living Cost Index. And this week, it showed costs rising 6.9% annually through the December quarter, compared with the Consumer Price Index, which was 4.1%. Now, to help understand all of this, let's bring in David Gruen, who is Australia's Chief Statistician and the head of the Bureau of Statistics. David, good to have you on the program. This is almost the vexed question, isn't it? But let's go and start with the CPI. You've got data going back 75 years, and that is our key measure of inflation.
That's right, Ross. So the CPI has been being collected by the Bureau of Statistics for 75 years. And in fact, the collection of living costs goes back even further to about 1912, when we collected information on prices for about 46 items across food, clothing and rent. And now the CPI collects prices for more than 100,000 items. And so the scale and scope of what we measure is massively bigger than it was if you go back far enough.
OK, so go back, but is the motivation for collecting that information today the same as it was 75 years ago, to work out the broad cost of living and to give regulators, including the Reserve Bank, some sense of where the economy is at that point in time?
Yeah, so obviously there are a bunch of other measures, but in terms of what's happening to prices broadly across the economy, the CPI is the measure that certainly the Reserve Bank focuses on. They look at everything, but the Reserve Bank focuses on the Consumer Price Index, and we do as comprehensive a job as we possibly can to measure the prices of the goods and services that the Australian community buys.
So explain to me the key differences between the Consumer Price Index, which, as I said, during that December quarter, annually riding at about 4.1%, compared with, say, for example, the Living Cost Index, which during that same period was showing an increase of 6.9%. Where's the key difference between the two?
Yeah, so the key difference between the two is that mortgage interest rates, the cost of servicing a mortgage, features in the Living Cost Index, but not in the CPI. And the other difference, you've quoted the 6.9, which is the annual rate of increase in living costs for employees. We actually calculate a series of these living cost indices. And for instance, for self-funded retirees over the last year, their living costs are estimated to have risen by 4%. So there is quite a bit of difference depending on how important mortgage interest charges are for the particular group of the community that we're looking at. But the number you quoted, which is for employees, as you said, over the year to the December quarter, our estimate of their living costs is that they've gone up by 6.9%, and the main difference with the CPI is that living cost index includes mortgage interest charges, whereas the CPI has a measure of the cost of building homes, but not of the cost of servicing a mortgage.
OK, so a lot of people would ask, in fact, this is an interesting question, why not? Why would the CPI exclude what is, for many Australian families, one of their biggest costs and one of the biggest imposts that they would have had over the past 12 months?
Yeah, so it's a good question, and it's a question I get asked quite often. And the answer is a little bit technical, but happy to take your viewers through it. The aim of the Consumer Price Index is to measure the cost of consumer items, and a house is an asset. So a house is something that all things, if provided things go well, is going to last a long time. And what you're doing with a mortgage is servicing the ownership of an asset. So that does not obviously belong in a measure of consumer prices, even though it's something that people have to. It's something that people clearly have to service to live in a house that they own and have a mortgage on. So the answer is that the Consumer Price Index is trying to measure consumer prices, not strictly what is the cost of living.
It's a really interesting thing there, because a lot of people would assume that the CPI is purely the cost of living. I want to go to one other thing which is important, which also, of course, the Bureau of Statistics measures, and that is wages. So the wages price index is also a key, because that can feed into all measures of inflation.
It can. And so we publish the wage price index on a quarterly basis. And the most recent data is to the September quarter, and it's showing an increase of 4% through the year to the September quarter. And we're going to be publishing the December quarter results on the 15th of February. So I think that's right. No, it might be the 21st of February. Anyway, late February is going to be the next release.
So that being also the case, all of these things work for inflation. And yet, as you know, there was pressure on the Bureau of Statistics to produce a monthly measure of inflation. Now, just explain the difference between the quarterly CPI, Consumer Price Index, and the monthly measure that you're now creating.
So, as you say, for a lot of our history, we have produced only a quarterly measure of the CPI. But when inflation started to rise a couple of years ago, we thought that it would be very valuable for people who are making decisions in the community, including the Reserve Bank, to have a more up-to-date measure of inflation. And technological change has meant that it is now cheaper to collect prices more frequently. So there are a range of ways that we collect prices that are electronic, if you like. So we have scanner data from the supermarkets. We do web scraping of websites. So we have a range of ways that we can collect prices more frequently at a reasonable cost. So in 2022, we introduced a measure of monthly CPI, which we call an indicator, because it doesn't update the full basket every month. It updates about 2/3 of the basket every month. But we have committed and been supported by the government with the financial resources to introduce a full monthly CPI, which we've committed to do by the end of next year, by which time we will have collected at least a year's data. And so we'll be able to publish year-ended inflation by the end of 2025 on a monthly basis.
And so therefore you'll be complete, and also will be in keeping with other major OECD countries around the world, the US, the UK, other places that already do this on a monthly basis.
Precisely. We are a bit of an outlier in the OECD. We're the only G20 country that doesn't have a monthly CPI. So we will after we've introduced it, we will be in line with all these other countries.
I'll tell you what, David, it is great to have you on the program. It's been an education for me, and I'm certain for the people watching this as well. So David Gruen, Australia's Chief Statistician, many thanks for your time.